Greetings, candidates, and welcome to the Manifested e-learning platform. Today we continue with the subject Advanced Financial Management. The topic is mergers and acquisitions. Today we move to the subtopic on valuation of firms for mergers and acquisition purposes. In this subtopic, we will be studying the use of the net basis. We have the PE ratio basis, the dividend growth model, the super profits model, the capital asset pricing model, and the discount free cash flows basis. So these are some of the ways in which for mergers and acquisition purposes. We'll be studying one approach at a time. In this lesson, we are going to focus on the first approach or basis, which is the net asset basis. But before then, it's important for you to understand that in the context of mergers and acquisitions, valuation is paramount for both the buyer and the seller in order to determine a fair and justifiable price. So valuation is the cornerstone of any successful merger or acquisition transaction. And both the buyer and the seller must determine a fair and justifiable price for the target firm or its shares. So the valuation is a complex process involving financial analysis, involving strategic considerations, and extensive negotiations. And as I said earlier, there are various models, there are various bases that are used, each with its strengths and weaknesses. And there is no single method that is universally superior. That's why professionals typically use a blend of income-based, market-based, and where appropriate, asset-based approaches in order to arrive at a comprehensive and defensible valuation. You understand? So valuing companies for mergers and acquisition purposes is a complex process that may involve many things. So in this lesson, we are going to mainly focus on the first approach or basis, which is the net asset value basis. Net asset value basis. Net asset value basis. The net asset value basis. Now, this approach is also known as asset-based valuation. Also known as asset-based valuation. Also known as asset. Also known as the asset-based valuation. Asset valuation. The asset value basis is also known as the asset-based valuation, and it is a method of determining a company's worth by focusing on the fair value, the fair market value of its underlying assets and liabilities. And in the context of mergers and acquisitions, it provides a floor or minimum value for the target company. The floor or the minimum value. The floor or the minimum value without adding any goodwill or anything else. The floor minimum value for any target. So the fundamental principle of the net asset basis is straightforward. It is straightforward. The net asset value then of a target will be equal to the total fair value of its assets minus the total fair value of liabilities. The fair market value of total assets, fair minus fair value, fair market value of its liabilities. That is how you arrive at the net asset value of a target. Fair market value of assets minus fair market value of liabilities. So instead of looking at the company's ability to generate future earnings, or instead of comparing it to similar market transactions, this method assesses what the company's assets would be worth if they were to be sold in the market, if they were to be sold off and its debt paid off. You understand? So that's how we get the net. This is the difference between the assets and the liabilities. And this method is relevant for companies that own significant tangible assets. So I'm trying now to answer the question now is how it is used or when. When do you use this method? When? Is this method likely to be used in valuing a target? When? One scenario is valuing asset-heavy companies. Valuing heavy asset companies. When valuing heavy asset companies, this method is particularly relevant for companies that own significant tangible assets like manufacturing companies with factories, machinery, inventory, like real estate companies whose primary assets are properties, like natural resource companies that hold land, mineral rights, and extraction equipment, like holding companies that whose main purpose is to hold various assets and so on. So if you are valuing such a company, then the net asset valuation method is recommended. Another scenario is liquidation. Liquidation scenario. Liquidation scenario. We use the net asset value method when a company is in financial distress or is being considered for liquidation. You understand? When a company is being considered for liquidation, then the net asset basis provides an estimate of the proceeds that could be realized from selling its assets to pay off the creditors. And this helps determine the minimum acceptable price in a sale or the value of the value to distribute to shareholders upon winding down the company. So that's the second situation or time or when the net asset value basis may be used in valuing a target or a company. 3, cross-checking other methods of valuation. At the beginning, I mentioned various methods of valuing a target. So now I'm saying that this method, net asset value basis, can be used to cross-check these other methods. So even when income-based or market-based methods are primary, the net asset basis can serve as a useful sanity check, such that if a company's earnings-based valuation falls below its net value, then it suggests that the company is underperforming relative to its assets base, or that its assets are worth more than its business as a going concern. You understand, candidates? Yes, you do. You do understand what I'm saying? We use the net asset value method to cross-check other methods like the income-based methods or market-based methods. So when you have valued a company using, for example, the income-based method, and the value arrived at is lower than the net asset value basis, then that may be an indicator that the company is underperforming relative to its asset base. Number 4, the fourth point is what we call purchase price allocation. Purchase price allocation or post-acquisition. That is to mean, after an acquisition, the purchase price needs to be allocated to the acquired assets and liabilities for accounting purposes. So the net asset basis provides a framework for this allocation, ensuring compliance with accounting standards, for example, the goodwill calculation. Purchase price allocation or post-acquisition. Let me say post-acquisition. That means that after the deal is sealed, Company A has acquired Company B. The assets of Company B ought to be priced or costed. So it is the net asset value, the value of the net assets that are arrived at when valuing that company, that will be used to allocate or to will be allocated to the acquired assets and liabilities for accounting purposes. Another time or scenario when the net asset based and net asset value method is used is small businesses. When valuing small businesses with owner-specific value, Small businesses with owner-specific value. Now, for very small businesses where the value is highly tied to the owner's personal goodwill or specific identifiable assets, when that is the case, then this method can be useful to delineate tangible asset value. Small businesses where the value is highly tied to the goodwill of the owner, or small business that has identifiable assets, then the net asset value basis method can be used to value such a business. You understand, candidates? Now allow me to proceed to discuss the calculation steps. Let's move to calculation steps. Calculation steps that we follow when determining the net asset value of a target. Now, one is to identify all assets and liabilities. Step number 1, identify and liabilities. Step number 1, identify all assets and liabilities. Start with the company's balance sheet. List all tangible assets like cash, like accounts receivable, like inventory, property, plant, equipment, and so on. Identify also all the intangible assets like patents, trademarks, customer lists. We have brand names, goodwill, and so on. goodwill, and so on. So identify all assets and liabilities. Then also list all liabilities, the accounts payable, the short-term debts, the long-term debt, deferred revenue, contingent liabilities, and all that. Identify all assets and all liabilities. Number 2, adjust to fair market value. Adjust to fair market value. Adjust to fair market value. This is the most critical step. The book values on the balance sheet, we know, are historical values. So it's important that the book values, which are just the historical cost minus depreciation, the book value cost, we know they reflect, they do not reflect the current market values. So we have to adjust the book values to reflect the fair market value. So it's important, for example, for the tangible assets to obtain appraisal for real estate, get appraisal for machinery, for equipment, and so on. Then value the inventory at its net realizable value. That is to mean adjust accounts receivables, for example, for uncollectible amounts and so on. We may also have the intangible assets, and that may be a bit challenging, candidates, adjusting intangible assets to a fair market value. That could be a bit challenging, but an attempt should be made to value the identifiable intangible assets like patents, like software, like customer contracts and brand value, using methods like the excess earning method or any other method that is relevant. So adjusting market values, you adjust the assets and also the liabilities to market values. The liabilities can be adjusted to their current fair value, and that might involve valuing long-term debt based on current interest rates or assessing contingent liabilities, okay, and so on. Then calculate the total adjusted assets. Calculate the total adjusted assets. Calculate adjusted assets. Calculate the total adjusted assets. Sum the fair values of all tangible and intangible assets and also liabilities. The same should happen to the liabilities. That is step number 3. Calculate the total. You make the adjustments of each, then you total. Step number 5 is to determine the net asset value. Determine the net asset value. And how do you determine the net asset value? This is the formula. Net asset value is equal to the fair market value of assets minus fair market value of the liabilities. You understand? Determine the net asset value. 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 Do you understand, candidates? Yes. Yes. So we've gone through the definition of the net asset value, when it's to be applied. These are the calculation steps. Let's now discuss the pros, the advantages. The advantages. Let us now analyze the advantages and disadvantages of this method. Let's begin with the pros. The advantages, pros. What are the advantages of using the net asset value method to value a target? The first advantage is transparency and objectivity. 1. transparency, and objectivity. Transparency and objectivity. This method provides a clear, tangible valuation based on identifiable assets and liabilities, making it easy to understand and verify. It's very easy to understand and verify because you are valuing assets, tangible assets, okay? Identifiable assets. If you are valuing a machinery, you can see it. If you are valuing stationery, you can see the stationery. So these are assets that are identifiable. The second advantage is related to the floor price, the minimum price, the floor price. The method establishes a minimum value for the company, particularly useful in liquidation scenarios or when earnings are unstable. 3, this method applicable industries. Applicable to specific industries. You recall we identify some of the industries. One is valuing heavy asset companies. We mentioned companies like those in manufacturing and so on. It offers, it's highly relevant for asset-intensive businesses where the value is primarily in physical assets. So it's very easy to value physical assets. If a company has intensive physical assets, then this method is recommended. Applicable to specific industries. Then number 4, this method has a balance sheet focus. Balance sheet focus. It has a balance sheet focus. What does that mean? Now, this method offers a detailed analysis of the company's financial health as reflected in its asset basis, which are assets and liabilities in the balance sheet. Number 4 or 5, the method is less reliant on future projections. Less reliance on future projections. There is less reliance on future projections. Less reliance on future projections. Now, compared to the income-based methods, it's less dependent on subjective assumptions about future growth rates or even market conditions and market conditions. So these are 5 advantages of the net asset value method. Let's proceed to the disadvantages or limitations, cons. What are the cons? The limitations. Now, the first limitation of the net asset value basis is that it ignores future earnings potential. Ignores, number 1, ignores future earnings potential. The method ignores future earnings potential. This is the most significant drawback of the net asset value basis method. Many companies, especially those in service, those in technology, or even high growth sectors, derive most of the value from their ability to generate future cash flows and not just from their current assets. So using this method to value such companies can be disadvantageous. The second limitation is related to difficulty in valuing intangibles. Difficulty in valuing intangibles. There is a difficulty in valuing intangibles. Difficulty in valuing intangibles. Now, while efforts are made, candidates accurately valuing all intangible assets like the brand reputation, the customer relationships, skilled workforce, proprietary processes is highly complex and often subjective. So undervaluing these can lead to significant undervaluation of the company, especially in the industries where intellectual capacity is key. So there is that difficulty in valuing intangibles. It's very easy to value tangibles, but tangible assets, but valuing intangible assets is not easy. It's not a walk in the park. 3, does not capture synergies. The net asset method does not capture synergies. The net asset basis does not account for strategic value or potential synergies like cost savings or revenue enhancements that an acquirer might realize by combining the target company with its own operations. And these synergies often represent a significant portion of mergers and acquisitions deal premium. So that is a disadvantage. 4, time consuming and costly. This can be time consuming and costly because revaluing every asset, valuing every liability to its fair market value can be labor intensive and expensive process, often requiring external appraisers. 5, static view. This method provides a set of value at a specific point in time, not a dynamic view of the company's ongoing operational potential. And that is a disadvantage. 5, is not suitable for all businesses. The net asset value method is not suitable for all businesses. In fact, it is less useful for service-oriented businesses or technological companies with the minimal physical assets and significant intangible value. So candidates, that's all for this lesson. Of course, at a later time, we are going to work out a practical example. It's important for us, first of all, to understand the theories behind the approaches. So candidates, in this lesson, we've defined the net asset value method of valuing targets or companies. Remember that in the context of mergers and acquisitions, valuation is a paramount for both the buyer, the acquirer, and the target. So valuation is the cornerstone of any successful merger or acquisition transaction. And while candidates, the net asset basis as a foundational understanding of a company's intangible or tangible worth, it's rarely used as the sole method. This method is rarely used as a sole valuation method in mergers and acquisitions unless the deal is for asset acquisition or liquidation. Because this is what we talked about. This method can be used in liquidation scenarios unless the company that is being valued is to be liquidated. It's not advisable to solely rely on net asset value method in valuing companies. So for most going concerns, it's best utilized as a supplementary method to provide a lower bound for valuation and to inform purchase price allocation, while income and market-based approaches capture the strategic and future earnings potential that drives most mergers and acquisitions. That's why in our next session, before we work out any illustrative examples, we will be discussing the PE ratio basis. In our next session, we are going to study the PE basis method. Bye-bye.